So in this video we are going to look at the Finviz screener, particularly in how we can screen for companies according to this book. Maybe you know the book, The Little Book That Beats the Market. So what is the idea? I asked Gemini to give me the magic formula in an image. Here's the idea. The magic formula is we find quality companies measured as high return on capital that have low valuation, so we have high earnings yield or like a low P to E ratio, if you know it. So these are basically the two things. You can stop this, maybe look into the magic formula explainer here from Gemini. I think it's a solid explainer. Okay, so let's go into the screener. First of all, we go to the screener and use fundamental here. We click on fundamental, then we sort for P and E low. So this is kind of a trick because we cannot combine it in the, as a score as it is suggested in the book. We cannot use this ranking combinations, basically rank them by PE ratio and return on capital, but we can do like a proxy that would probably yield similar results. No financial advice. Okay, so first we look only into low P to E stocks, then we go to financial. And we click on return on equity, which is, I like this most. I think solid return on equity, it would be a good proxy metric for return on capital. We could also sort by return on asset, which would also include debt. Might be a bit more sensible approach. So both approaches would work, I would say. And now we can just go over the companies. And for instance, here see Nucleus would be the first one, SSM, Sono Group, NV would be the second one, SBR, Sabine, Royal Trust. So this could be like the beginning of our analysis. And actually this TRAW was also one of the highest return on equity stocks. If we sort for return on equity, we can see TRAW is basically the same one, Traws Pharma. So this company seems to fit this criteria very well. So usually these are highly correlative, so should work. Both metrics should basically work. And yeah, you can also filter out maybe companies with low debt if you are like the return on equity could be tricked, kind of. You can have an arbitrary high return on equity if you have a lot of debt, so you can use the screener to basically only use companies that have very little debt. And you can do this here, I think, in fundamental as well, but we need to scroll right. So we click fundamental and then we scroll right. Debt to equity should be low, right? Now you are basically more conservative and you see the correlation is much higher. So I think this would be a solid first screener to go with the companies. And yeah, these Mesabi Trust, North European Oil Royalty Trust. So these kind of companies should fit the formula of the little book that beats the market. Okay, thanks for watching. If you like these kind of videos, these short tutorials about finance and AI, then give me a like and subscribe to the Thinkster channel. You can also check out the Thinkster newsletter. It's an AI newsletter. Just go to blog.thinkster.com/AI. and you can join my AI Nuggets email list. We have 130k readers and we send regular emails, sometimes daily, sometimes weekly. It depends on how much is happening in the world, but we keep you updated about the broad topic of AI and with a particular focus on finance in many instances. Okay, thanks for watching and see you next video. Bye.